Welcome back, Stock Explorers. Ready for another deep dive?
Always.
Today we're looking at Intel, specifically their performance and all the news surrounding them over the last year.
And there has been a lot of news.
Yeah, we're talking a stock plunge, a leadership shakeup, even rumors of a takeover.
So much to unpack.
Definitely. For those who haven't been following every twist and turn, Intel stock is down a pretty staggering 60% since this time last year.
Yeah, pretty much everyone's wondering if this is the beginning of the end for them or if they're, poised for some kind of amazing comeback.
Well, to even try to figure that out, we need to start by understanding exactly what Intel does right.
Yeah,
What are their core businesses?
absolutely. So Intel's a huge company, but we can break it down into a few key areas.
Okay, good. Because otherwise I think we'd be here all week.
So first we have the Client Computing Group, or CCG. That's essentially their bread and butter, their consumer-facing business.
So the stuff we're probably most familiar with.
Exactly. It's where you find the chips that power most of the world's laptops, desktops, tablets, all the...
Right, the classic Intel Inside sticker we all know.
Exactly. Now, beyond that, we've got the Data Center and AI Group, or DCAI. This is where they're targeting the huge data centers that power the cloud and also any enterprise that needs serious computing power.
Which is a lot these days.
Oh, yeah. As AI and big data keep growing, this segment has massive potential for Intel.
But also a lot of competition.
Definitely companies like NVIDIA have really been making moves in that space.
So we've got the brains of our computers and the power behind the cloud. What else?
Well, they're also looking toward the future with the network and edge group NEX. It's about bringing computing power closer to where the data is actually being generated and used at the edge of the network.
Instead of relying on these centralized data centers.
Right, so think smart devices, autonomous vehicles, even industrial automation.
So they want to be everywhere.
You could say that. And then, of course, we have Mobileye.
Ah, yes, Intel's big jump into the world of self-driving cars and driver assistance technology.
Yep. And with Mobileye's recent IPO, it's clear they see this as a huge e-growth area.
Especially with all the hype and investment around self-driving cars.
For sure. Now let's talk about a segment that maybe isn't as flashy, but is super important for their future. The Accelerated Computing Systems and Graphics Group, AXG.
Okay, so what's that all about?
Basically, they're focused on high-performance computing using powerful CPUs and GPUs to tackle these really complex problems in areas like scientific research, financial modeling, you name it.
So like the heavy lifters of the computing world.
Exactly. And it's a tough market. Intel's been facing challenges here, especially from AMD.
So a lot of competition all over the place. For Intel, it sounds like they like to keep busy.
That's one way to put it. But one segment I think is particularly interesting is Intel Foundry Services, or IFS.
Oh, yes. This is where things get really interesting.
So with IFS, Intel wants to become a big player in contract chip manufacturing.
Like going head-to-head with the giants like TSMC.
Exactly. They're not just making their own chips anymore. They're opening their factories up to produce chips for other companies.
Wow, so they're trying to become the chip maker for the whole industry.
It's ambitious, to say the least, especially since TSMC is currently the leader in this space.
Super ambitious.
But, Intel's business segments do show ambition. However, their recent performance hasn't exactly reflected that, which brings us back to that stock price.
Yeah, that 60% drop isn't something you can just ignore. What happened?
Well, a big part of it is that intense competition we've been talking about. Companies like AMD and NVIDIA have been taking chunks of their market share.
Especially in data centers and high-performance computing.
Right, and then you have the manufacturing delays. Intel's been struggling to keep up with the pace of innovation.
So they're missing opportunities and losing even more ground.
Exactly. And to top it all off, their CEO, Pat Gelsinger, stepped down just last December.
Yeah, his departure was a huge surprise. He seemed to have a really bold vision for Intel, right?
He did. He wanted to regain manufacturing leadership by bringing more production in-house, so less reliance on those outside foundries like TSMC.
And wasn't he pushing to speed up their tech development, too?
Yeah, he was pushing for 5 nodes in 4 years, a very aggressive timeline.
Which might have contributed to those manufacturing issues.
Potentially. So now Intel has 2 interim co-CEOs, and they're actively looking for a permanent replacement.
A lot of uncertainty at the top.
For sure. And all this uncertainty has, of course, led to some takeover rumors.
Oh, yeah. We can't forget those Qualcomm and Elon Musk potentially buying Intel.
It sounds wild, right?
It does. I mean, would either of those actually be a good fit? And what would it mean for Intel's future? Lots to discuss.
Lots to discuss. Let's dive into those questions next.
Okay, so we've talked about all the different things Intel does, but their stock is down 60%.
Yeah.
There must be a reason, right?
Oh, there are definitely reasons. To really understand what's going on, we got to look at their financials. Let's start with the income statement.
Mm,
That tells us, how much money they're making and how much they're spending.
right, the basics.
Exactly. And one of the first things that jumps out is that revenue decline. We talked about it a bit earlier. In Q3 of 2024, Intel brought in $13.28 billion.
Which sounds like a lot.
It is, but it was actually down over 6% compared to the year before. For a company as big as Intel, that's a pretty big deal.
It's definitely a sign that something's up.
So they're bringing in less money. What about their expenses?
Well, that's the key question, right? Intel has been investing a ton of money in research and development, and they've been building these new manufacturing facilities.
Which you kind of need to do if you want to grow in the long term.
Exactly, but it's expensive, especially when revenue's going down.
Yeah, it's a tough balancing act. You need to spend money to make money, but if you're not careful, you can end up in trouble.
And that's where we see the impact on their gross margin.
Right. Gross margin tells us how much profit they're making on each dollar of sales after accounting for, the cost of actually making those products.
Yep, and Intel's gross margin has been shrinking, meaning they're either making less profit on each sale or their costs are going up, or maybe both.
Probably both. So it's kind of a double whammy for them. Pretty much. And all of this culminates in that massive net loss they reported for Q3A, whopping $16.64 billion.
Yeah, I remember when that news broke. It was a shock.
A big part of that loss came from what are called impairment charges. Basically, they had to write down the value of some of their assets, admitting that they're not worth as much as they thought they were.
Ouch. So it's like admitting you made a bad investment.
Exactly. And a lot of those charges were related to their manufacturing facilities, which makes you wonder if their big push to bring production in-house was maybe a little too ambitious.
Well, it's definitely a risky move, especially in an industry like semiconductors. Things change so fast.
Absolutely. But the income statement only tells part of the story. We need to look at the balance sheet, too, to get a fuller picture of their financial health.
Okay, so remind me, the balance sheet is basically a snapshot of what they own, what they owe, and what's left over for the shareholders.
Exactly. It gives us a sense of their overall financial position. And one thing that stands out is their debt. As of September 2024, Intel had over $50 billion in debt.
That's a lot of debt.
It is. Now, debt isn't always a bad thing. Companies often use it strategically to finance growth.
Right. It's like taking out a loan to start a business.
Exactly. But when a company is facing declining revenue and profits, like Intel as a high level of debt can be risky. They still have to make those interest payments regardless of how the business is doing.
So it adds another layer of pressure.
For sure. But it's important to remember that Intel is still a giant company. They have a lot of resources. They have a global brand, cutting-edge technology, and a massive manufacturing infrastructure. They also have a decent amount of cash on hand.
So they're not going bankrupt tomorrow.
Definitely not.
Yeah.
But they do need to address those declining revenues, get their profitability back on track, and start managing that debt. And of course, they need to find a new CEO, someone who can make tough decisions and lead them through this turbulent time.
It's a lot to handle.
Yeah.
But that's what makes this whole situation so interesting. Intel is at a crossroads.
They really are. And in the final part of our deep dive, we'll look at how they're managing their cash flow. That's the lifeblood of any company. We'll also take a closer look at those takeover rumors and what they might mean for the future of Intel.
Okay, so we've talked about Intel's different businesses and looked at their income statement and balance sheet. But to really understand their financial health, we need to look at one more thing: the cash flow statement.
The cash flow statement is all about tracking the movement of cash in and out of the company. It shows us how they're managing their money on a day-to-day basis.
So it's like looking at their bank account and seeing what's coming in and what's going out.
Exactly. It's about the actual cash they have to run the business, invest in new projects, and pay off debts. And when we look at Intel's cash flow statement, a few things stand out.
Okay, what jumps out at you?
Well, first, their operating cash flow, which is the cash they generate from their core business operations, has been under pressure.
Makes sense with the lower revenue and shrinking margins we talked about. Less profit means less cash.
Precisely. And this impacts their ability to, invest in future growth and manage their debt.
So are they cutting back on those big investments then, like those new manufacturing facilities?
Yeah, they've actually reduced their capital expenditures, or CapEx, quite a bit in recent quarters.
So they're spending less. Is that a sign that they're in real trouble?
It's probably a combination of things. Part of it is strategic, conserving cash during this uncertain time. But it could also be that they're having to tighten their belts because of those financial headwinds.
Right, so they're being more cautious. But what about all that debt they have? How are they managing that with this cash flow situation?
They're using a few different strategies. Cash on hand, of course, proceeds from strategic initiatives and also additional debt financing.
So they're juggling things,
Yeah,
trying to keep it all balanced.
exactly. One interesting thing they're doing is this smart capital approach. They're partnering with investment firms to share the costs of building new manufacturing facilities.
So like finding someone to help with the down payment on a house.
Pretty much. It helps them spread the risk and reduce the financial burden. But the big question is, can they generate enough cash flow going forward to keep up with their growth plans and pay down that debt?
That's what everyone wants to know. It's a big gamble.
It is, but Intel is known for taking risks.
Speaking of risks,
Mm-hmm.
we can't wrap up without revisiting those acquisition rumors, Qualcomm or Elon Musk buying Intel.
Yeah.
It still feels a bit surreal to me.
It's definitely a wild idea. But let's break it down. For Qualcomm, buying Intel would give them a huge boost in the PC and data center markets. They could potentially go head-to-head with NVIDIA and AMD.
It would shake up the whole industry. But would it even be possible?
It would be incredibly difficult. Integrating two giant companies like that is no joke, and Qualcomm would need a ton of money to finance the deal.
What about Elon Musk then? Would it make sense for him?
Well, it kind of fits with his whole vision of pushing technology forward, especially in AI and autonomous driving. Intel's chip design and manufacturing capabilities could be valuable for Tesla, but again, financing would be a huge obstacle. Intel's market cap is way bigger than Tesla's.
So yeah, doesn't seem very likely, at least not right now.
Exactly. These are just rumors. There's no guarantee that anything will actually happen.
But it's definitely something to keep an eye on. Intel is at a crucial turning point. The decisions they make in the next few months or years will determine their future, whether they can become a leader again or if they'll end up being acquired.
It's a fascinating story, and it's not over yet.
That's why we love covering these companies. It's like watching a drama unfold. But for investors, it's important to remember that this is real money, real risks, and real rewards. So do your research and be careful out there. And that's a wrap on our deep dive into Intel. Thanks for joining us, Stock